Everyone assumes because they got product market fit in crypto for the first time, but it wasn't like Arthur didn't invent perpetual. So perpetual
Oh
futures
yeah.
are actually that was actually proposed by none other than Robert Schiller back in 1992, and I just find that such a fun like
Yeah.
path dependence sort of fact of history. It never really took off in TradFi, but just found product market fit with our specific type of degens. Hey everyone, this episode is brought to you by Sei, the blazing fast parallelized blockchain which is unlocking Solana-like performance for the vast ocean of ETH devs out there. Now, you're going to be hearing all about Sei and their new V2 upgrade, but if you take away one thing, the EVM is here to stay. There are some problems with it, which we're going to get into later in the episode, but Sei, and especially their V2 upgrade, is helping solve that. So thank you very much, Sei, for making this episode possible. Hey guys, big shout out to Uniswap. Uniswap is delivering the best on-chain trading experience, period, bar none. They've got a bunch of cool new features coming out, like Uniswap X, limit orders, real-time data insights. We're going to be hearing all about those features later in the program. But for now, Uniswap, thanks for making this episode possible. We'll get right back to it.
All right, everyone. Welcome back to another episode of Bell Curve. Before we jump in, quick disclaimer. The views expressed by my co-host today are their personal views, and they do not represent the views of any organization with which the co-hosts are associated with. Nothing in the episode is construed or relied upon as financial, technical, tax, legal, or other advice. You know the deal. Now, let's jump into the episode.
All right, everyone. Welcome back to another episode of Bell Curve. Today, I'm joined by Nick Trileski, who's a crypto options trader at Cumberland DRW. Nick, welcome to the show, man.
Hey Mike, nice to meet you. Nice to be here on Blockworks. It's gonna be fun.
Yeah, man, this is gonna be a great one.
Yeah.
Yeah, I think what I'd love to do is, you have a really interesting seat in this industry at an options market making desk, and I think there are a lot of folks that understand would say that they understand what's going on in derivatives, options, etc., but don't have a very clear picture. And you have a very boots on the ground understanding of what's going on. So, can we just start at a 10,000 foot level and just describe like what does the sort of options and derivative space look like in crypto today?
Yeah, sure. So options and derivatives in crypto started quite a while ago, actually, surprisingly. It was like 2017 when Deribit and these offshore exchanges started to kind of pick up steam and people started trading small size on them. But I would say the explosion of crypto options really happened in 2021 as more and more sophisticated players kind of came in and started to market make, and then also start trading strategies to generate yield and to also take various kinds of directional risk using options. But the space in general has been kind of a quiet grower underneath the explosion of the crypto derivatives markets. Obviously everyone knows Perps. They're just a great product that is very simple to understand. There's just linear risk on instruments with a funding rate. So for a lot of retail and a lot of institutional participants, Perps have been a very good product for either hedging their portfolios or just expressing risk in a capital efficient way. But at the same time, options have been growing, as kind of more and more sophisticated people enter and wish to express opinions on non-linear risk. So like if they want to express direction at a certain strike price or at a certain maturity or play some kind of event, and as you know, we've had a lot of events in crypto. Options kind of allow people to structure like trades in that kind of way. They also have a lot of implicit leverage in them as well. So, and another benefit of them is that you get rid of the risk of liquidation. And and the biggest thing, like the biggest end users kind of in the overarching ecosystem of options traders are yield generating strategies. So like people who have large holdings of BTC or ETH or, are miners or staking providers, they're the ones that kind of come in and say like, hey, we have fixed costs. We generate all this BTC and ETH. We want to also, figure out a way to extract yield from this so that we can pay for our fixed costs. So they have been predominantly the first mover and first entrant into this market. And then the rest of the market has kind of grown around them.
All right. Maybe we could. So I think you just kind of outlined the three major instruments, right? There's futures, options, and then perpetuals. So maybe we could talk a little bit about sort of the history and like current state of the union of each one of those different instruments, like who are ultimately using each of those things, then what the market structure looks like that supports trading, and then maybe we can sort of back into at the end of the conversation something intuitive about what any sort of metrics coming out of each one or the usage of each of those products tells us about just sort of like where we are in the cycle, which is like the perennial question that everyone's
Yeah,
always interested.
everyone's always trying to time that. But yeah, I mean, yeah. So crypto obviously started off with spot, like people spot exchanges were the first things to kind of come around in crypto, and it was just very simple to understand, But as people started to trade crypto and wanted to secure borrow to short something or to run a neutral position, it became pretty obvious that you needed a future product. So one of the biggest like kind of first movers that took off on this space was BitMEX. I'm sure everyone the everyone remembers those days when
Run the
BitMEX and
stops.
yeah, run the stops exactly. So BitMEX was one of the first movers in that, and obviously Binance, Deribit, Bybit, FTX, all these other exchanges obviously came out and like leaned in, and they just crushed it with Perps. Like that was the product to use. Um, so that
Also, Nick, fun fact, like this is I've got one fun fact about perpetuals. Everyone assumes because they got product market fit in crypto for the first time, but it wasn't like Arthur didn't invent perpetuals. So perpetual futures are actually that was actually proposed by none other than Robert Schiller back in 1992. And I
mm,
just find that such a fun like
yeah,
path dependent sort of fact of history. It never really took off in TradFi, but just found product market fit with our specific type of degens in
yeah,
crypto,
it's
which is
it's
super
really
funny.
it's really fascinating. It's such a good. I think part of it is just that we had better technology like in current day to like support this like perpetual funding. The way that banks and settlement operates on like traditional exchanges in the U.S. where it's like T+1 settlement. I think was probably not too supportive of that. And then on top of that, they just banned any kind of swaps. So like this, yeah, that was like kind of a regulatory reason for why perps are still not allowed in the U.S.
Wait, can you what is the connection between the settlement time there? And actually for listeners who might not be as familiar with like the actual structure of perps, can you just describe how those actually work under the hood?
Yeah. So perps have some kind of funding rate, which just depends on the difference between the index price and the market price of the perpetual future. So that funding price is usually paid out continuously or in some kind of time block. I mean, a lot of people look at it on like an 8-hour basis, so 3 times a day. Some exchanges have it continuous. And then, yeah, it just hits your account, and it's very easy to think about why, like, what the funding rate is. People look at it annualized or people look at it on a daily basis. So it's like, okay, if I risk, if I have $100 of position and I have to pay, 1% funding, I know that my margin decreases by this amount. The other thing that's nice about perps is that there's different kinds. There's some that, have margin in underlying collateral. So you can margin BTC to get long BTC, or you can margin USDT tethers to get long BTC, and vice versa with shorts. Um, so, I mean, that's the general product is very simple for someone to understand. It's just that there's either a long funding or a short funding. You either paying funding or collecting funding based on the balance of positions in this particular instrument. So it's and it's just like it's pure delta direction. So you just have exposure and price, whichever way it moves. There obviously you also run the risk of liquidations if your margin is depleted. So it allows greater capital efficiency. And one of the biggest like unlocks with perps with these exchanges coming around and trying to win over retail users is that they allowed
Yeah.
huge amounts of leverage. I mean, Binance and all these other exchanges like kind of had leverage profiles on small accounts like up to 100x leverage. And I think we start to see some of that as well in the on-chain world as they start creating new perp exchanges on chain. Like that's how they're drawing in all these new retail users. And on top of that, I think also they were very quick with listings of new tokens. That was a pretty big reason why people love to use perps, because every time there's a new token, you had these implied futures markets, allowed users to speculate and get long or short.
And Nick, as part of the reason as well, I would guess that this is the demand driver on the exchange standpoint for why they do that is there's probably an enormous amount of demand for VCs that have unlocks or something like that. Or like, they bought some illiquid token. It's now been marked up like 100x. It's about to go live and they just want to lock their gains in. So they've still got the underlying, but then they'll just go short the perp to lock those gains in. Is that like a big reason why you think like driver of that market?
Yeah, for sure. And I think just on top of that, they can also hedge other instruments that are closely correlated that be more liquid and have better, funding profiles, because usually like when some kind of new hotly anticipated coin releases a token and there's like all this lockup that, sometimes extends past a year, it's very difficult to carry a short perp position to lock in your gains for, when the funding rate, when every single VC that invested into it goes through and hedges it and pushes the funding rate to something that's unreasonable, where
Mm.
you're not gonna, not really gonna make a lot of money. And on top of that, um, it's also capital intensive. So you have to, maintain margin. If you're short, if you're short a coin that just released a token and you have some kind of locked token on the other side, and it starts to take off from a retail perspective, you have to keep posting more dollar margin USDT collateral. So it could quickly turn into a capital inefficient trade. But overall, especially as the unlocks get closer, we typically see some kind of action in perp funding as people kind of hedge their allocations. So
Mm.
yeah, it's definitely a useful tool for funds and venture. Yeah.
So one of the debates that you often see is, all right, perps have been this extremely dominant instrument that especially like retail will choose. But honestly, I feel like there's a decent amount of institutional adoption of perps, however you want to define institutional adoption. I think like amongst crypto native institutions, let's call it. And every now and again, people say, well, what about options? Options are the dominant, instrument that more traditional institutional money managers like use to speculate in TradFi, and it just hasn't really seemed like that's taken off in crypto. There's obviously Deribit, there's Avo more recently that has on-chain options, but it just doesn't seem like that's taken off. And my sort of pet theory for that, it's a little bit of I mean, I just think the average probably retail user, in some ways, they're more sophisticated than their TradFi counterparts, but in terms of like options or more traditional sort of market sophistication, they're maybe a little bit lower. It's like easier from a user perspective, and I don't know. Like, what do you think
Yeah.
about that? Like, why do you think perps just have so much better adoption than like options in crypto?
Yeah, that's the age-old question that people have been trying to solve for quite some time.
Mm.
Yeah, and you're right. Like in TradFi, if you look at just the general how much market cap or open interest there is in options on, say, like a stock. Like, I mean, Coinbase, for instance, is like one of the top 10 open interest stocks in terms of options on like US exchanges. That's how much, and the options open interest, obviously outweighs anything that's in the future space. So like if you look at a product that has futures like e-minis, the options open interest is massive relative to the futures open interest. In crypto, we kind of have the opposite. Like, we have huge futures open interest scattered across exchanges like Binance and CME now, which is the market, kind of like the market leader. But the options open interest is like, not like a crazy multiplier of that. And that just shows like that the demand in the option space has not been as big as it like should be in a fully developed market. And I think it's primarily because the primary users of options are going to be people that are a little bit more sophisticated, and that has been like kind of the trajectory of every single developed market. It's like pension funds, like long holders, banks, lenders. So it's like these people that own a lot of it on their balance sheet and have to manage it effectively and do it through options and try to think about that holistically. Retail most recently has been like a very big growth factor in like zero DTE options and like short dated options for speculation. I mean, we saw that mania in 2021 with GME and other stocks, and most recently we saw this pick up like in short dated options, zero DTEs. So retail still exists, and I think one of the reasons why like that kind of traditional finance retail, like in traditional markets, retail has not kind of spilled over into options on crypto is primarily because of like there's not enough liquidity, and on traditional finance exchanges you have insane liquidity on these options, and then here you just don't. There's only like what the main leader exchange is Deribit, and it's just closed off to the majority of American I mean, it's closed off to American retail, so you're not going to get that. And then on top of that, you also have uh, they have the ability to trade perps. So like people have ability to trade futures, and it's just like an easier product to understand. So for retail, it's a better product that they can understand the direction, they can understand the funding, and they can trade it in a much more cohesive way. Versus on options, it's a little bit more tricky to understand. So you have to deal with many different strikes, many different expiries, and I think that the current way that exchanges kind of build it makes it really difficult for a retail consumer to come in and say, hey, like I want to trade some options, and then you have like a million strikes and you have a million expiries, and there's no like really clean interface that simplifies it for you and says like, hey, if you want to express like upside direction or downside direction on this particular crypto, like this is what you got to do. I think for the average retail participant, they just come in and they're overwhelmed with how many strikes and instruments there are. And I think that's something that will, like, as the UX and liquidity matures over time, it'll get solved. And then as there's more institutional interest and more deep markets and more flow that's going one side and like both two-sided flow essentially, I think this is something that's going to kind of mature and coalesce into like a developed market. And this is something we have actually seen over the past like kind of 9 months to a year. Yeah.
Mm. So one more question before we go a little bit deeper into options, still on the perp side. What are the different venues that like where volume is sort of aggregated around? And then how do you see the relative development of like perps volume versus spot in general? Like I'm actually not sure what the relative volumes are. I know derivatives, there's far more volumes on derivatives these days than spot in crypto, but like what does that look like just perp versus spot, and how do you see that trend continuing?
Yeah, for sure. So the various exchanges. So there's obviously offshore exchanges like Deribit and a few others, and I would say you could count the on-chain exchanges like Avo as well. There's onshore, which is CME, which has been, recently has flipped Binance in overall open interest in futures on Bitcoin. ETH not yet, but over time, I think that'll also kind of happen. So that's the regulated way to trade options in the US. And then after that, there's OTC. So that's something that we Cumberland DRW kind of specialize in. We think that we see roughly like 50% OTC and like 50% like exchanges as like the total volume profile for us. So OTC is kind of is special. It's more tailored for the customer. So it allows customers to margin in USDC. It allows customers to margin in dollars. It allows customers to margin underlying token, and really fits their profile of what they're actually seeking to do, what they're seeking to trade. If they're trying to just buy options, it's very simple. They just pay the premium and move on. If they're trying to sell options, they have to obviously margin with coins or with dollars. And I think the flexibility allows them to express it, or allows the flexibility of margin is kind of the big winner for why people like to trade OTC. And on top of that, also just different expiries and different strikes, different instruments, like more exotic options that people don't have listed on exchanges as well. So those are the three venues. Each of them have benefits and drawbacks. CME obviously is a highly regulated U.S. derivatives exchange, which is never has seen any sense of stress at all. Including like 2008 crisis, COVID. Like no one ever thought that anything would happen on the CME. Like no one ever had any kind of trust issues with the CME. People blow up all the time during these kind of crises, and they get carted out, and the CME stands and has this 100-year history of never blowing up. Derivatives exchanges that are offshore, I mean, everyone knows every cycle there's at least one that gets carted out. The last thing you want to do is have options positions, which are harder to unwind than a futures position on a failing exchange. So yeah.
Why is it harder to unwind an options position?
Well, if you think about it, like if you're structuring an options position of many different strikes over many different expiries versus like you have 10 coins that you just need to like hit buy and sell on to get out of them and clear out your margin, it can get a little bit more difficult there. So options positions also get tricky. When vol markets go crazy, it might be harder to get liquidity versus like if you're never not going to have liquidity in BTC or ETH, for instance. So Yeah, counterparty risk is kind of central to why offshore exchanges are perceived as a risk versus like CME. And then over the counter, same kind of thing, way more customizable. You face counterparty risk on directly to the market maker that you're dealing with. Some market makers have, especially if they're crypto native, we saw many crypto native market makers get carted out last cycle after, all the loans and all the FTX and exchange things blew up. For someone like us that is a traditional finance company that's been around since the 1990s and handled many different kind of tail events and crises, it's not as much of a risk because we also have like publicly traded debt and we have the risk management of like a sophisticated TradFi firm. So we face less counterparty risk on our end. But yeah, you kind of give that up give you have to kind of give up certain things to trade on one venue versus the other. Some venues will also have better pricing. Some venues will have worse pricing but better margin. So it's kind of a trade-off in deciding which one to deal with. I would say that institutions and like high net worth individuals will generally opt for either like, something where they can more like closely feel the counterparty risk and either face a regulated exchange or get like some clarity on financials versus more retail participants won't really care about counterparty risk. They're just trying to enter and exit a trade for like a day or two, so for them it doesn't really matter as much.
Hey everyone, wanted to give a big shout out to today's title sponsor, Sei. Now, I want to talk to you guys a little bit about why I think Sei is cool from a design standpoint, a big problem that it solves for ETH devs out there, and then some cool stuff that Sei has coming up. The reason I like Sei from an architecture perspective is, again, it's a very fast blockchain, parallelization, all of that stuff, but Sei has essentially been custom building block space, which is for consumer apps and dexes. Now, they have some very cool features which enable that. So twin turbo consensus, optimistic parallelization, Sei DB, all of this stuff allows you to reduce the time to finality, make for very, very fast transactions. So if you're building a consumer app or a DEX, this is basically the blockchain for you. If you've been building in the EVM, you love the EVM, but there are some restrictions about it that don't support your app. So maybe you can't do fast enough transactions or it's not parallelized, whatever it is, you can now take all of that stuff that you built. You don't have to start from scratch and you can build it on Sei. Now, recently they've launched V2, but also public DevNet. So the way that you can follow that and keep up to date is go and follow Sei Network on Twitter. All right. Thanks, guys. Hey, everyone. This episode is brought to you by Uniswap, delivering the best on-chain trading experience, period, bar none. Now, if you know the history of Bell Curve, you know I did an entire season on DEXs with Dan Robinson of Paradigm. That one was a blast. We ended up talking about Uniswap quite a bit, so I'm a huge fan of the product and team. There are 3 really cool new features that I want to talk to you about today. 1, limit orders. 2, real-time data and insights. And 3, Uniswap X. So limit orders, you guys know what those are, but now you can buy and sell 700 tokens at your price on your terms. Also, we're going to get into this later, but it's powered by Uniswap X, so you don't have to pay any gas fees. 2, real-time data and insights. Now, when you log onto this Uniswap interface, you can see real-time charts, transaction logs, pool data, and project information. Looks really neat. All that information is in one place, so you're basically good to go just from Uniswap. And then finally, there's Uniswap X. You get 0 gas fees, no fees on failed transactions, and you get to source off-chain and on-chain liquidity. And if you want to nerd out about the construction, I think it's really cool. There's an RFQ-based system. They farm it out to different fillers so that you're getting the best execution price. So finally, if you want to go check out all this stuff, which I highly recommend that you do, click the link at the bottom of the show notes so they know that I sent you. Cheers, guys. Nick, let's talk a little bit about some of like who is using options today. So we were talking about this dynamic of maybe liquid funds that are benchmarked to Bitcoin or Ethereum, and then they use options to sort of juice their returns is the wrong thing, but basically look like they're performing favorably relative to their benchmark. Can you describe that dynamic a little bit?
Yeah, sure. So I would say I talked a little bit about the yield generation. Obviously, if you have large holdings of BTC and ETH and you write calls on it, or you also can write puts on it, like if you want to allocate more, you can sell some puts and get exercise on them and buy more downside. Basically, buy it if it goes down and get paid funding and get paid the premium of the options. Same thing on the upside. If you want to let go of some of your upside and sell some calls as the price is going up and as volatility is exploding, you get to collect premium on this and you get to sell some if it goes above the strike. That's kind of the yield generation framework. And on the other side, you have these like liquid funds that are, like you said, benchmarked to BTC and ETH. Their specialty most likely is not to actually trade the liquid. It's more to go out there, like get involved in protocols, invest liquid into like different DeFi, invest into venture capital, and then on top of that, maybe hold some liquid BTC and ETH. But ultimately, their LPs are expecting returns that are in line or benchmarked to BTC and ETH. So if we have a landmark year for like uh, majors like we did last year, where BTC just outperformed everything, their LPs are tapping on their back and saying like, where are the returns? For some of them you could promise like, oh yeah, well this is just how the cycles happen, but for some you also need to show that you're going to be in line with this performance. So we see a lot of like liquid venture funds like come out and try to buy upside in options to capture this kind of move where BTC or ETH outperform, and then they know that they have all their other venture capital investments that will score if the cycle kind of continues. But it keeps like a smoother performance for them overall, and that's kind of a theme that we saw this year, especially like after as the ETFs were getting approved and after they got approval, is that people started to kind of just buy upside so that they didn't miss out like this further rally. Yeah.
Out of curiosity, I know it's probably different at every fund, and actually some of these funds almost came at it more from a trading or a more hedge fund oriented standpoint, and then they started to do some venture investing. There were definitely some funds that came at it more from the venture standpoint, and were like, hey, we should be either they got distributions of liquid tokens, or they started to say, hey, there's some upside to having a liquid part of our book as well. But these funds that are starting to trade options, like, do you think that's some of these investors necessarily have the competency to understand the options? Like I would just think about like venture as a skill set, and buying or trading options is like a very different skill set. So I'm just like wondering how that kind of plays out in practice.
Yeah, I think for yield generation, and like I guess I kind of hate calling it yield generation. What you're doing is really selling vol risk premium or volatility risk premium. You're selling like the the demand for volatility, which is usually like over time carries some kind of risk premium as to like how it actually realizes. So that's just kind of like a technicality that a lot of people like to highlight. But I think for people that are selling options for yield, it generally I don't think you need like that much options expertise because you know exactly what you're doing. You are saying that, oh, BTC right now is 70K or whatever, 65K right now. I want to let go of some upside above 70K. Like I would sell Bitcoin above there. I can collect for June, actually say like 100K, like everyone's talking about the 100K strike. For June, I can collect like $2,700 right now to sell that call. I would sell Bitcoin at 100K in June anyways. Like if it gets up there, I would sell it there now. Right now I can sell that call for $2,700 and generate that P&L per BTC, or generate that yield per BTC. So it's very simple to think about, and I think that's kind of like the approach that a lot of funds kind of come into it with. And I don't think that requires a lot of expertise. Obviously, timing wise, like if you can time it better, if you can time like, pops in BTC to sell it like on a pop and sell it on a pop in a lot of volatility, that's better. So I think some funds might have an edge in that. So they can enter and start trading it like that. Obviously, for some funds also can't trade perps. It's, they don't have a mandate where they cannot, like, especially after FTX, like have capital on other exchanges that support perps. So how do they express leverage? They come in through options over OTC. So they will, if they think that we might have, if they just saw like a flurry of on-chain activity or like a flurry of retail entering the market, they might come in and say like, oh, short dated, I want to buy some like upside calls, and effectively it gives you like similar leverage profiles to running a perp and just like running a trade on a perp. Obviously it's very defined risk. You buy a certain strike, you know that your terminal P&L based on where it settles. So that's kind of like the people that enter these kind of these are the kind of funds. I don't think it takes that much competence to do that. To run more like relative value and like BTC versus Ethereum and like trade like different parts of the term structure where they're trading one expiry versus the other and like saying like, oh, I think like June is very expensive versus like December is very cheap because of the election or something like that. I think that takes a little bit more competency, but like for pure like price action oriented things and yield generation, I think it's a very approachable topic.
So on the subject of volatility, this is another one of those things where I feel like I understand it at a relatively high level. I think if you ask many other folks in the space, they would say they understand it, but it's unclear sometimes like what the implications of like high or low, either realized or just regular volatility is. So can you just give us an overview of like how you think about volatility in general, and then maybe we could start to back into some historic information. I know we were talking about before the show like ETH
Yeah.
volatility was at an extremely low level at one point this year, and like how should folks who are listening in here like kind of generally think about volatility as maybe like a timing indicator in markets?
Yeah, for sure. Well, yeah, I mean, volatility is just a measurement of it depends on the time frame that you measure it. So people like like to measure it over the past month or like a past week. So it's just a measurement of like price action and how volatile price is. And just to give you a range, like so people understand, it's referred to in an annualized way. So like, what's the annualized volatility of Ethereum right now? It's roughly like 60% annualized. What is the range for that? Well, it can go from like I talked about in the summer last year, especially when there was a large call overrider on in Ethereum. It got as low as like 25, 30% annualized, and it can range up to like it can explode up to like 150 to 200. So this is kind of the range that you're dealing with, and yeah, the way you do is you measure it over various different time scales, like over a week or over a month, and then you try to predict it based on like future events like the merge or EIP 4844 or the halvening or the ETF. Like all these things will generally increase volatility because there's going to be more price action, whether up or down. You don't care. But as far as timing goes, timing volatility, like timing cycles with volatility is pretty important because you generally start to see like a pretty like every single top of the market has usually had some kind of very high volatility event leading up to it. Um, I don't think we're there yet because vol is creeping. Like vol got so low over the last, especially the summer. Like over the summer, it got so obliterated, and it's starting to climb up there. We're in like the 80 vol range, which a few funds have always been talking about. Like, oh yeah, this is like where things start to get kind of interesting because we generally always see some kind of explosion of like north of like 100 vol. So that's kind of where we're at right now. Like volatility has been steadily, like as these ETFs came on market, has been climbing and it's gotten into like 80, even though it kind of has its ebbs and flows, but generally that's where it's at and that's where it's priced. And I would say like December is kind of the target. December and June are the two like points of interest right now. It's like how does it how does everything play out with the election and how does everything play out with the Bitcoin happening? So that's like where you see a lot of trading and people kind of speculating on like, okay, right now those two are like around 80 vol. Like if it really takes off, where does it go? So
Right.
yeah,
And there's a relationship, right, between the price of volatility and the profitability of selling options, right? And
for sure.
one thing that you and I were talking about a little bit as well before we got started here is this dynamic of miners selling call options as we approached previous all-time highs. And I don't know, I do think there was a little bit of market psychology, like we've talked about on this program. Like I've talked about
Yeah,
it many times. Like I thought the sort of mental model that I think was consensus in the market is once we break through all-time highs, it's go time. And it
hmm
hasn't really been like that this time. It's actually been sort of a break. And one thing that has maybe changed, you sort of hear anecdotally as people, yeah, usually retail is like, okay, what should I buy? But now you actually have bag holders from 2021 or 2022 saying, okay, is this the right time that I should finally sell these bags?
for sure.
And I do think maybe that's something that's a little bit different. I mean, what's your read on the whole psychology around the all-time high?
Yeah, I think there's always like, it's such like psychological barrier to cross all-time highs. I remember we had the same kind of thing happen in previous cycle with 20K. I think we broke off like 20K down to like 16K, and then like we finally revisited it, and then like Elon, was it like Elon, I guess, like tweeting that would like really like sent us through it. But yeah, it's definitely like a psychological barrier, and you see like, I would say like a lot of sophisticated investors like come in and just like, every time we tap that area, they just start like unloading calls that they had before, or you know taking some kind of profits, especially the last few times we visited. But at the same time, you have those people that are like, oh my god, I'm underexposed, they sold everything out. And there's like a famous like trade that one fund did, like where they sell out all their spot at all-time highs, but then they don't want to miss out on further upside, and then they just go out and buy calls. So we saw like some of that activity too. It's like where people are clearly selling spot at all-time highs, and then they're just coming out, turning around and buying calls. Like, oh, if this thing like pops off to like, we're at 72K, like if this thing goes to like 80, 90K, we want to see some of that appreciation as well. So you kind of start to see like a little bit two-way in that space. I think this cycle, we you know we're also seeing like a lot of these like DeFi coins that people kind of held on to and never sold, and that's always like been like a thing in crypto. It's like, oh, you forgot to sell like the all-time highs, like or you didn't sell it on the way down, or you added or whatever. Now it approaches back up. Like, what do you do? I think that's like actually like a benefit of options, is that it allows you to like when you're selling calls, it allows you to like force yourself to sell, and otherwise you generate some kind of P&L if it doesn't eclipse that area. But yeah, that's just, I think that it enforces like stricter like profit taking to your mindset. So
Mm. What do you I mean, what is your overall read, I guess? Just backing into, all right, so we had like a sort of a similar situation play out in, if you go back to like November of 2020, where yeah, it kissed like 19K, kind of went back down, meandered sideways to downish for about a month, had a couple of like attempts to break through, and
mhm.
I guess that feels actually very similar to today. I don't really remember what volatility was doing, or I do remember at that time listening to none other than Suzu talking about. I think 3 Hours Capital, one of the first big trades that they made very successfully actually was buying a bunch of cheap volatility at that time. So they were buying a bunch of those options, and then sellers got sort of steamrolled. I mean, do you see a similar risk today, right? If there's a bunch of folks who are selling options that if prices really take off, they could. It's kind of like the picking up pennies in front of a steamroller type trade, or what's your sort of analysis there?
For sure. Yeah. I mean, we see a lot of funds that are continuing to kind of accumulate an upside, especially like, again, like the 100K area, like 90 to 100K area, especially as you approach the election. I think that's kind of like the trade that everyone likes to think about, like where does BTC end the year? So obviously, if they're buying, there's someone else selling, whether it's market makers or like, on the other side, yield generating funds selling it. There's definitely that. I wouldn't say volatility is cheap anymore. Like, I think the real opportunity was to really get long it in the summer, where it was just like, I mean, but people at that point have kind of given up. Like, people thought the opportunity was to get long it like in March and April, and then like it's like people were just giving up. And I mean, there weren't any like long dated options trading at that time, so maybe it was like the right time was October, when you could actually get some exposure to the ETF stuff.
Mm.
But yeah, I do think that like there's people still continuing to accumulate options. If we do kind of break all-time highs again, and really send it to like 100K, we will, the vol will definitely perform. It always performs whenever you break out all-time highs, and it could, we've seen it go above 100. So I think that's definitely the angle that those funds are playing for. There's also ways that you can express it like in way more conservative ways, because they're paying a lot of premium for these calls. But there's also ways that you can like structure like a trade. Like, I was looking at the 150K call 1x2, where in December it's like roughly, or no, sorry, it's 170K 1x2. So like that's something like that would be like you outlay almost next to zero premium to buy it. Obviously your max win on that thing is 70,000. So it's between the two call strikes. That's your max win, and then your break even. So it goes back to zero at 240. So like if you think Bitcoin's not going to go above 240 by the end of this year, I don't know. Some people probably think it could, but it's like a pretty solid way to play BTC going up to 70K with outlaying like very little money, or
Mm.
next to zero premium. So these are the kind of trades that you can structure like in options that are really interesting, versus like if you want to get if you think that BTC is going to end at like 140 or 150K, in spot, it's very capital inefficient, where like you have to pay a ton of funding and margin to put something on like that. Versus in
Mm.
options, like you can just literally outlay $0 and post margin, and you will, if BTC ends up with 70K and you do just one contract of this, you make 70K. Obviously, if it goes anything above 240, that's when you start losing money. But that's like a pretty good, like, you can see how high volatility is in general, that something like this, is a trade that you can actually put on.
Mm. And Nick, can you like, I mean, just from your seat at Cumberland DRW, what does the appetite look like on the institutional side here? And probably folks who are listening along on this call have seen those charts of open interest on CME for both
Yeah.
Bitcoin and ETH kind of being up only. What is your sort of sense on what the demand looks like on the institutional side for these sorts of
Yeah.
products?
Yeah, I think the demand is growing a lot. I think there is a lot of barbarians at the gate, I would say, with these ETF options at the moment. Obviously, they got delayed. Now it's looking like the end of this year it's going to get approved, but there are a lot of hedge funds, either traditional or crypto native, that, again, want to trade on a regulated derivatives exchange. Have not, like, maybe they don't trade on the CME because they, traditionally trade just pure equities. Those funds, were able to make Coinbase be like I said before, like one of the top 10 options traded, and MSTR was like up there as well. They're trading all these derivatives of what they actually want to trade, which is BTC and ETH. Eventually, when those things have ETFs and ETF, eventually when ETH has an ETF, and then when those two have ETF options, I think it's going to be a huge unlock for institutional demand that loves to trade equities and has everything set up with their prime brokers and everything like that. That will be like a pretty big demand influx. And on top of that, I mean, we've seen, while that has not occurred yet, and while we're waiting on regulators to, approve this, we've seen pretty tremendous growth. And on CME, I mean, this product just keeps, chugging along, making new all-time highs in open interest as these funds kind of get onboarded, and OTC as well, as people like, start to think about how are they going to take profit, how are they going to be more sophisticated with managing their risk. Maybe they weren't last cycle. I mean, certainly showed how many people didn't hedge or didn't think about downside risk at the peak of last cycle.
Mm.
So that just we're seeing like continued like onboardings with ISDAs of funds coming to us to start trade. Yeah.
So, do you think that this market, like now really moving into the editorializing, part of this, like, does it feel a little bit like this market has barbelled? Like you've seen, so obviously, CME volumes and open interest has been, there's been a massive spike there, lots of institutional, like Bitcoin, ETH buying, etc. And then
Mhm.
it sort of feels like meme coins are working, and then
Yeah.
that's just about it. And my assumption would be the missing participant here is retail, and you really have like crypto doing these like PvP sort of games. They like, they're the natives are the ones that have seen these cycles play out. They know it goes Bitcoin, ETH, blue chip DeFi, all L1 slash altcoins, fin with Doge, like that's where, and they're trying to skip to the end of the cycle and just buy the meme coins right out. And it feels like that's what's happening over in sort of meme. Like even if you just look at what's going on today, everything
Mhm.
is down. Like Bitcoin's down, ETH is down anywhere from like 5 to 10%, whatever, but Catcoin is up 43%. This is
Yeah.
not an endorsement of Catcoin. That was just the number one trending thing that I see on
Yeah.
CoinGecko. I probably shouldn't even name specific meme coins on this podcast, but you know what I mean? Like, does it
Yeah.
feel like
Yeah.
that's what's going on?
Yeah, and I think that's something that you touched on before. It's like a lot of people like coming in and like, they were vesting their whatever blue chip DeFi over the last like 4 years. And, this is like their final vest of them taking this part off.
Mm-hmm.
So yeah, I mean, some of these protocols obviously have tremendous growth and tremendous TVL and, tremendous use case. Like, the classic blue chip DeFi. But at the same time, I think you're also just getting like all these new coins that are entering the market at these like in like very high either market caps or FDVs. And I think they're just being priced more accordingly. Look at like blue chip DeFi when it first came out, and then when it ripped a lot, was not blue chip DeFi. It was something new where people just started using it, and then no one like really knew what the hell it was and how big and how useful it could be. It just like later now we refer to it as blue chip DeFi because people keep using it. People keep using Uniswap and Aave and Compa or all these other things. Now you have these like new narratives come out, whether it's like algorithmic stable coins or restaking is really hot right now. And these protocols are going to launch at like billion-dollar FDVs, like multi-billionaire, like or double-digit billion FDVs. So that capital is coming, or that capital is coming from somewhere, and I think that's like what the next like blue chip DeFi of the next cycle is going to be. And I think it's just getting priced a little bit more accordingly as it comes out of the gates. And I think they're also this like slow issuance of points, the whole points meta is like kind of delaying like this liquid token being around and then it ripping versus like it just kind of launches to this FDV and people like come out and have points and they sell it to liquid funds that end up allocating to it like right on the launch because everyone's kind of aware of it. It's been around for so long and has generated so much user growth. I think that's kind of the difference of this cycle. And then the meme coins are just in the background, kind of, there's money sloshing around the system. That's the exhaust. That's how I always think about it. Like meme coins are just like the exhaust of how much money is sloshing around while people wait for whatever, and yeah, retail just loves it. It's, explaining BTC and ETH is simple to retail. They'll buy it. They can now buy it in their brokerage accounts. Explaining liquid restaking or like explaining, how this like perp protocol is going to work is, and why they should buy that coin is a little bit more difficult to DeFi. Explaining it's cat coin season and buy the hottest cat coin. It's, that's a lot easier. And I think that's why they end up buying them.
Yeah, I don't, I'm like torn on this because I mean, I just haven't seen on the retail side of things. Like, I'm just so used to now when, crypto's taking off, I get all these random calls, like people come out of the woodwork. I just haven't really seen that quite as much. And I don't know. I mean, obviously retail was buying Dogecoin back in 2021, but that took Elon Musk to tweet about it, right? It wasn't like everyone was doing that. We needed the most famous guy in the world, arguably, to tweet about Doge and SHIB and whatever. I
Yeah.
don't really think that retail for the most part is like finding out about the next, like now these things, I mean, you had like Bohm or whatever that went up to $1
Yeah.
billion in 24 hours. Like that's not your grandpa's, like your mom and pop retail,
No.
right? Like that's 100% insider crypto natives just aping in to that. I just
Yeah.
think they're different crowds would be my
Yeah, I think it's probably different crowds because I think a lot of like people have set up their Coinbase accounts and they probably already bought Doge last cycle and they see it where it is now. Maybe they come in and buy some more, but yeah, maybe people are exploring. I mean, people are exploring Solana much more because it's much more palatable for retail to go in and like pay a few dollars for a swap rather than pay like $100 for a swap on mainnet. So I mean, I think there's some people that are kind of wading into the on-chain world, and there's some evidence of retail there. I would say a lot of it is also, probably just like crypto natives that have been around and made a lot of money in the last like 6 months, and now they're just like, playing these rotation games. So yeah, it's probably not the mom and pop retail just yet. I don't think those people have entered the on-chain world in mass, and I don't think there have been any like super hot exchange listings that outside of, I guess, what WIF or I don't even
yeah.
know which exchanges that's listed on. I mean, that's been kind of like the
I
big
think it's
meme
on
coin of the
Binance.
cycle. It's on
Yeah.
Binance. Okay. Yeah.
Yeah, I think, or maybe it's Bonk that's on Binance, but yeah, Whiff is the one that's done super well. I don't know. I just, there was an interest. So we just did this conference, DAS London,
Yeah. I was there.
DRW. Oh, nice, great.
Yeah.
There was really interesting. So 1000X, one of the podcasts on our network, Avi and Jonah, we did a live recording, and Avi asked this question like, how many folks in the room like bought one of the Bitcoin ETFs, and literally in this room of like 400 people, 2 people raised their hand, and then it was like, well, how many people own crypto? And the entire room raised their hand. And I think that just like, what does that tell you? Like that tells you that there aren't that many new, like I don't own any of the Bitcoin ETFs
Yeah.
because I have Bitcoin spot, and I'm
Yeah.
probably, there's not much, like I'm not the target audience for this, am I?
Yeah.
And so I just think it tells you that there just hasn't been much new,
There's
like
been much new.
eventually,
Yeah.
yeah. Um,
It's possible, yeah. I mean, I bought the Bitcoin ETF just to get I love how when you buy a new ETF, they deliver the prospectus, the fat stack of paper. So I have that sitting on my desk for the IBET ETF. That's the fun part about it. But yeah, I would say it's hard to gauge, like, whether it's a lot of new retail entering versus this big institutional entry that has happened, especially in BTC. I mean, it's pretty evident that, through the CME open interest, like now you have a lot of hedge funds running the carry trade, which is like, buying spot ETFs, selling futures against it, and kind of providing capital into the ecosystem. So you just start to see, I think this is a much more institutional cycle that we have seen kind of take
yeah.
off. And the retail bid, it maybe it will come, but anecdotally, a lot of my friends that I've chatted with and like talked to, I think still feel a little bit stung by the last cycle where they haven't like come in with open arms into something just brand new. And I think that's like the retail bid in crypto is always caused by some kind of like new breakthrough in use, like something that like you can, like, I mean, Uniswap was like a huge thing that like it took a while for people to realize what it was. And DeFi, that was what drew retail in. Right now, there's not like anything that breakingly new in the space that is going to draw them in to do the same thing. So
Uh, Nick, I got a question for you. I was seeing on Twitter today. Shout out to Larry Engineer, Larry0x on Twitter. Yeah, he's
mhm,
asking this question about Athena. So if Athena's
mhm,
strategy is delta neutral, why aren't hedge funds already doing it? So basically, I mean, this is something I sort of remember from last cycle as well, when people started talking about this carry trade or the basis trade, et cetera. They're like, why aren't people hopping in and closing the spread? If you could just basically get 20%, quote unquote, risk free, why aren't more people doing that? And I think that's basically what Larry's asking here with this question of like, if there's 20 to 30%, you know uh, basically risk free yields, or at least it's being portrayed that way a little bit. Not that Athena's necessarily doing that, but you know what I mean.
mhm.
Like,
Yeah,
why aren't more like why aren't more people in the hedge fund community hopping in to close down that spread? Feels like a no brainer.
yeah. I mean, they are very much so in BTC and ETH, like on the futures and CME, like that's where they can get access to. They are hopping on and doing it. I mean, there still exists like so much. It just becomes a capital game. Like the basis trade overall is like how much capital do you have and how much can you put into it, and how much demand is there to push it the other way. So it's like if you can evenly match the capital, like if all in a perfect world, your basis or like whatever your carry rate is going to be the risk-free rate. But it's like if you look at like the gold market, for instance, like it's pretty evident there, like every single future is like perfectly lined up with the risk-free rate, because that's every single bank in the world can go out there and trade this thing, and they have like infinite capital to match all the buyers and sellers. In crypto, I mean, now with the ETFs it's kind of been like the big unlock for hedge funds to that previously like couldn't even touch coin. Now they can just buy the any one of the ETFs and sell the CME listed future, and that will capture the basis. It's not perfect. I think it's like last I checked, it's like 12 or 10%. So it's not quite down to like 5.5 where like it could potentially go. But it's also like it's also like a capital game. Like if they run out of if you are posting dollars on CME, you're gonna if it keeps going up, you have to post more and more dollars. So you have to have more capital and kind of work that into the basis trade. With the ideal basis trade, which is kind of what Athena captures, is where you post coin collateral. So like you don't have to add additional collateral. You can just post Ethereum to sell Ethereum futures. So those kind of collateral, that kind of collateral is like obviously, yeah, those will actually trade even closer to in line to Fed funds. Um, yeah, and I think it's a capital thing, and there's just not enough people with enough capital, and there's too much demand for leverage on the other side. which is why it hasn't kind of compressed down to that level. But like if banks could participate in, in coin margin futures, those things would be like like it would be flat. Right now it's just a few funds, and the funds thing to have. It's like, do you want to earn 20% yield on that, or do you want to go airdrop farm and earn like 70% yield or whatever? So yeah, it's like it's an opportunity cost.
So if it's just a supply and demand or like supply of capital problem, like what happens when more capital comes online, either directly from Athena itself or just from other like hedge funds that are looking to close down that spread? Like, yeah, I guess I'm sort of asking like, are you bullish or bearish on Athena here? What does that mean ultimately for the future of that product?
Yeah, I mean, ideally, that's that's what they want. I mean, they'll have more TVL, and it'll help them grow and be able to issue more and more stables. So I think that's the fact that they launched into an environment where there's a very high basis trade is probably like pretty good timing,
Mm.
because it draws more people to create TVL and like loop this thing and kind of grow the protocol in general. Yeah, I mean, Athena is an interesting idea. Obviously, I'm sure you could go and find the FUD on Twitter about, running such a very large, you know, running such a very large basis trade. There's definitely risks with basis trades. You can look up how many times have basis trades blown up in very liquid securities like treasuries. It's a lot. Like there's a lot of funds, very sophisticated funds that blow up on the basis trade all the time for funding, whatever.
How does that happen
Um,
in like treasuries? Like, how does that scenario happen that a big fund blows up?
Yeah, I mean, it's like some kind of demand goes, some kind of either supply or demand comes through that pushes the basis trade outside of their risk limits, and then
Mm.
the people that run it are so levered because it seems so safe. So they just like borrow more and more and more capital and leverage it up so much just to like capture that yield. Um, then something happens, some kind of big shock like COVID blew out the basis trade on a lot of people because you know the bid or the offer disappears, and then all of a sudden you're mark to market with an exchange, and then you have spot on the other side. If you're mark to market with the exchange leg, so in this case on Athena, it's going to be short futures. If that goes through the floor or like goes against you, then you could potentially get into trouble there.
Mm.
Because then you have basically realized P&L on one side, and then you have unrealized P&L on your spot on the other side. So that's like that's a part that can always kind of impact you. And then on top of that, when people run very large like trades like that, people generally know about it because it either shows up in an open interest or whatever, and then that becomes like a target for people to like, oh well, they'll have to get out of it X, Y, and Z here. And I mean, on top of that, like I guess you're always gonna have with something that like runs most of its a trade on a offshore crypto exchange, like you're gonna have counterparty risk as well. So people were freaking out about counterparty risk of USDC just a year ago, and it was being held in a US bank. You know, half of Athena is being held on, offshore exchanges, basically. So it's like there's always counterparty risk there as well.
Mm.
So those
Mm.
are the risks of it. You know, you can weigh them however you want. Um, I don't know. It's hard to like say like how it will play out in the future. But I mean, everyone's always talking about how we need like an algorithmic stable coin. We'll see how it works out. Don't really have
Yeah.
a straight opinion on which way it's gonna go.
That's
Yeah,
tough, man. It's
yeah,
I was seeing today people. I mean, everyone always wants a decentralized, algorithmic coin, and it's like
yeah,
it's just this is the challenge that Maker ran into all those years ago when it decided to go down the RWA strategy. It's really just like, what is
yeah,
the demand to borrow here? So maybe at some
yeah.
point Athena runs into something similar. But
Yeah,
Nick, this has been great, man. You've been super generous with your time. I guess like
of
any
course.
closing words for the listeners, or if folks want to find out more about you, follow you on Twitter, whatever. What's the best way to do that?
Yeah, for sure. I guess closing thoughts is that I think this crypto options market is going to continue to grow. I think it will get to the point of like the stature of size of how developed or options markets are in general. I think retail will be there. I think people will be trading zero DTE options just like they did on GameStop and all this other stuff in no time. As the UX liquidity and access kind of grows of it. And I would say that for institutions, it's a pretty great time to get involved because you're always going to make it in crypto if you're here, but if you don't be careful and manage your risks, that's sometimes how people get wiped out. And I think options are just a great way to do that. And doing it OTC or on exchanges with good market makers is generally the right way to do it.
Awesome. Well,
Yeah.
Nick, thanks for coming on, dude. We'll have to
Yeah.
do it again soon.
Yeah, thanks a lot.